everybody's waiting for crash. They may increase rates, maybe one, even some people say twice. I don't think so, but it's possible.
We now see South Florida running in a position where for a lot of homeowners, they're seeing the homes are 10 times what they're making in a year. And their argument is that's unsustainable, and that's got to lead to some kind of correction.
Okay, so let me address that. So number one, when you're looking at price to income, which it is an important metric, you have to think about, are those numbers true? The price and the income. So prices are true because we can get them out of whatever it is, MLS, and they're reliable. Yeah. The income numbers, those are very tricky, specifically for South Florida. Number one, because we know that recently a lot of the money that is flowing here is being earned somewhere else, or basically wealth that moved here. Yeah. If somebody wealthy moved from New Jersey or New York or Boston, they may not have an official income that is qualified to make this, whatever it is, the income number higher, but they're coming with enough wealth, so that supports that. And also we have, of course, a lot of income that's unreported. Now, unreported income is true and exists everywhere, but we know that it's more so in South Florida. I think that is safe to say. So a lot of people earning quite a lot of money that is unreported. Again, that is contributing to a low income reported compared to what the real income is. So whatever numbers that you see that's price to income, the real number is actually lower than that. So that's number one. The second thing is that price to income ratio is important, but to me, more important when you're talking about recession or correction, anything like that, is that we have prices in the market that are not supported by fundamentals. And what do I mean by that? So if you think about what happened during the recent housing boom in the 2000s, you see prices went up significantly, very fast, and then rents stay stagnant. So you basically have prices that are not supported by fundamentals, which is rent. This is a definition of a bubble. This is not high price, it's a bubble because you have prices not supported by rent. It did not make sense to buy at some point, then you rent the same units. What's happening right now, it's very different. You have prices go up and rent prices going up with it. And when you see rent prices that going up with purchase prices, number one, it provides fundamental support. And number two, it provides evidence that those prices are actually what people are able to afford. Now, it's very easy to say, prices are so high, nobody able to afford it. But it's silly because prices only go as high as people can afford, especially when you don't talk about speculation, especially when you talk about rent prices. Purchase prices, if you buy something with 0% down interest rate that is temporary, then it's a speculation, then people can pay whatever. But when you're talking about rent prices that are consistent with purchase prices and people pay those, it means that the income is coming from somewhere. That gives me a lot of comfort. The other thing that gives me comfort in the market, to say that it's expensive but not in a bubble, is the fact that everybody's waiting for the crash.
When we do our studies, obviously we do them at a hyper-focused granular level. There's always going to be sometimes a period of correction within subprime markets. Overall, obviously, they're going to get better. I don't think you can just blanket go out and say, just go into Brickell and buy right now.
No, look, yes, of course, it's a little bit more sophisticated or, I guess, complex than that. But you have to really think about, okay, are you looking for a home for your family or are you looking for investment? And those are two different scenarios. So basically, if you're looking for a home for your family, I believe that in a hot city that is expanding over time, as long as you're not grossly overpaying or the market is not ridiculously, unrelated to rent prices, basically the best time to buy is when you need a home. And really the risk of not buying one and the market running away from you is more than the other risk, which is you're not going to buy, you're going to rent, and then, that you're going to buy and prices will come down. So for those people, I would say as long as the market is reasonable, you find a place that you like and you have a need for that, go buy a home. Now, for the investors, and you're talking about, jumping to a different elevator and having other opportunities, I think those are the more sophisticated investors. Those are not the investors that are buying one unit at, Rich and Rise and, renting it. This is different type of investors. And for those, yes, they may be trading between one type of investment to a different one, maybe to a different city, maybe to a different sector, maybe outside of real estate altogether. I don't think that's a big part of who owns condos in Brickell. I really don't.
Do you have any thoughts on our the interest rate situation?
Of course, yes. I mean, that is the first. Well, the first question is that what do you think about the market when people meet me? And the second question is that what's going to happen with interest rates. It becomes definitely a hot button, top of mind for many people, whether they're looking to buy a home, staying on the sidelines, or investors. And really, what happened with interest rates is very different this time around than other times because the disruption in the market was basically a broken supply chain. It wasn't an over-demand that overheated the market. So when you have a broken supply chain, it creates shortages for different reasons, not because there's not enough supply and because there's no supply chain. So then the Fed, of course, started increasing interest rates in order to slow down the market, and we see that it's working. And actually, I would argue more than just it's working for delay. So a lot of the things that are already happening in the economy, you don't see in the data. The recent number that we saw was 3% inflation. This is basically where we want to be. Yeah, we want to be at 2%, but 3%, it's right there, especially if it's coming with a lag. We're already at 2%.
So you believe we're legitimately there, because some argument says, oh, we're not there, it's all just fluff, and that's just, hyperbole. But from your what you've seen academically and studying
those
out
that say
there,
that it's fluff would say that, so all the CPI numbers are fluff. So we still need to go to a fluff 2%. I don't believe it's fluff. I believe that, yes, CPI can be measured in different ways, and maybe some people disagree with how it's being measured, and that's okay, but that's a different argument. The point is that our target of slowing inflation is already happening. I mean, first of all, you see shelves are full in most cases. That is by itself easing.
Ability to get a car. I mean, that was a good example.
Ability to get a watch, or ability to get the kind of milk that you want in the supermarket, or diapers, or formula, or any of those things. This is less of an issue. Ability even to get a home. Okay, so all those things that we could not get our hands on just before, now you can do them. You maybe have to pay, but the prices, even though are high, they're in place. The Fed want to appear very aggressive because that's, they really have two tools. One of them is that they are tightening the market. Another thing is telling the market they're going to tighten the market. They're both just effective. They rather tell the market they're going to be aggressive than actually being aggressive, because being aggressive is an action that is very difficult to take back. And telling the markets we're going to be aggressive is something that...
So it's like having a child and telling them you're going to spank them and actually spanking them.
You rather tell them you will if they don't behave. So that is what the Fed is doing. They may increase rates, maybe one, even some people say twice. I don't think so, but it's possible. But I do think that what you're going to see is probably toward the end of this year that you're going to see the bets of interest rates continue to go up will disappear, and you're going to start talking about interest rates coming down. And when those talks are happening, then the spread between a 10-year treasury and mortgages will shrink. Sure. Right now, it's as high as 3%. Mm-hmm. It should be, whatever it is on average, about 1.8%. Just by shrinking the spread, you're already in the mid-5s. Selling houses, but people, of course, come to me with, should I buy a home? Or talking to agents, what should I tell my clients when they're sitting on the sideline? And again, if they want to buy a home, and the decision point or the main factor is that we're not buying now because we're waiting for interest to come down, they will come down, but when the time they do, the prices will go up. Because if higher interest rate, they don't bring them down, then lower, that means market is resilient, low interest rates will bring them up. And then they'll basically have to have more competition and probably overpay. So what I would advise them is, if you think about buying a home anywhere in the next year, just buy it now.
So date the mortgage, marry the home.
Yes, and refinance later. Yes, of course.
Yeah, which totally makes sense. And I say that too. I mean, look, would you rather pay a little bit more on your mortgage, or would you like to pay another $500,000 on the value of your house, the cost of your house?
And as a lot of people say, well, really what I care about is the mortgage payment, but it's not the full story, right? Because then when you talk about resale and you talk about equity in the home and wealth creation, all that, what you pay for the home really matters. So you better have and of course you're locking the price that you pay, and then you can take advantage of mortgages as they're coming down. And if this is what you anticipate to happen, which I think a lot of people do, it's just a matter of time. I believe the process is going to start sometime later this year, early next year. Some people maybe disagree, and it will happen another 6 months or maybe even a year later. Okay, but it's not 10 years down the road. And even if it is, let's say interest rates do not come down, that's because inflation stays high. The biggest component of inflation is housing. That's almost by definition mean that housing prices will continue to go up. So almost any direction you look at this, you're going to be losing by waiting for interest rates to come down. And again, I'm talking about not just go speculate buy a home because you're looking for interest to come down. I'm talking for people that actually need a place and they're not buying right now because interest rate 7 and they want it to be at 5.5. Once they go below 6, when there's a 5 in the beginning, psychologically people will start looking at homes, the demand will increase and the market will change.
And the psychological winds as they blow are massive influences. I always, it's kind of like the Ray Dalio, play the player, don't play the game. And looking at what the human behavior is en masse and talking, again, we have these conversations with hundreds of people, thousands of people every year. It's interesting to see the sentiment and their mood and their motivations and what they're fearful and what they're hopeful about, because, it does give us an underlying sense of what they're going to do. Their gut is still going to drive them.
Especially when we talk about residential homes that are, primary residence, a place where you're going to be living with family. I mean, we know that this is, yes, it's a financial decision, but it's a personal, emotional decision.
It's a need.
Yes.
So we've touched on some of the fundamentals, and I just want to let people know when they're going out there and they're trying to get data and they're trying to get information, because you are so in this, and there's a lot of sometimes misdirection of data out there. We've touched on interest rates being something to pay attention to. We've touched on, the supply and demand, dollar per square foot. Are there any of the other metrics out there that you would say, if you're going to look and try to understand the market, and as you're teaching your students to understand the market, what metrics should you be paying attention to that you may not be looking at right now through your Zillow or Trulia, search?
I think the trends stay the same. One thing maybe you did not mention, people did not look at before, is rent prices, even when you purchase home, because again, that's the fundamental. Mm-hmm. I do think that the change. Okay, so people talk about prices go up and down, but the rate of how they go up and down when you adjust for interest rate at the same time is extremely important, because when people say stagnant, so people talk about stagnant market here. It's like, okay, so the market's slowing down. Maybe that is actually very impressive. That market slow down if you consider that at the same time rate from 3 to 7. That is very different than if rates stay at, they went from 7 to 3 and then the market are stagnant. I will tell you, well, there's a problem here.
That would it makes sense.
So looking at all of those factors together is very important rather than just looking at them individually.
You raised, this is something that we were discussing earlier on kind of off camera before we were shooting this, which was about how I remember back when I was doing the studies at the condo market back in 2010-11, we were looking at this process where the conversation was months of inventory as our supply and demand, one of our fundamentals. And the conversation was, we have 110 months supply in this market. It's going to take us 9 years to absorb this product. So you shouldn't be buying right now because we're going to be oversupplied.
And of course,
but that was off that speed.
Yes. And of course, the assumption that we're going to stay at the same speed.
Which is a huge mistake. So really, I think it's really important to understand the speed, the absorption rate, the speed of transactions that are occurring within the market, because it might be one speed right now, but when that shifts, everything else does too.
Yes. So when economist is telling you, well, this is true, all other things equal, which is a standard economist answer, you have to, of course, understand, and that economist knows it's himself, that all other things are never equal. All other things are never the same. So, for example, yes, now we have X amount of inventory in the market. Well, what happened to the pace of how people are going to buy houses if and when interest come down? All of a sudden, you're looking at a very different number, even if the amount of inventory is the same, just because the speed of how you consume that inventory is becoming faster.
Something that has come up in conversation a lot over the last 6 months, which is really, it's a very granular question. It's very hyper-specific, but the insurance game, the insurance premiums and what's going on right there, and dialogue about people who have older homes in flood zone areas that are built at lower elevations are now seeing massive premiums being increased across their annual flood insurance, home insurance, and obviously older condos having assessments, having higher fees. Have you had any conversations of that? And is that factored in? Are you seeing any patterns there that are worth mentioning?
Yeah, I do think that the insurance issue is, if there's one concern I have about the South Florida market, is the insurance situation. I generally do not like government get involved. I do think that this is one of those places that, for the general good of everybody, I think those are the kind of places where government should be involved, with providing some kind of a comfort to the insurance companies, some kind of subsidies, some kind of a system that make it more affordable, because the recent increase in insurance rates are unsustainable.
And the control, the ability to almost it become a monopoly, where there's no free market conditions anymore.
The problem with those things that, nobody's getting involved and nobody getting spooked until it become a real problem. And I think we are right where it's becoming a real problem.
Yeah.
That it's becoming a conversation among politicians and some decision makers that hopefully will help the market adjust to that situation.
I believe right now, if things aren't addressed the way they're addressed, that there are homeowners in areas, flood zone areas, and older homes who have, homes that they maybe, they renovated the inside, but they didn't do anything with the exterior structure, or they didn't elevate their homes, they couldn't. Those are becoming areas where they're becoming, a pig in the room, where those are people I'm saying, if you market's good, but if you're going to sell, these are the people who should be selling, because I'm concerned that they could really end up having a piece of real estate that's really considered land value.
Yeah.
As buyers look at the insurance premium and saying, there's no way I'm going to pay double on this house that I'm going to pay over a house up the hill.
Yeah, no, and that is true. I've done a study. Actually, it wasn't in South Florida. It was actually the study area was in North Carolina, but it's the same thing. Basically, looking at houses somewhere in the Outer Banks area, and looking at erosion of the land on those homes that are located basically first line to the ocean. And even though the issue of land erosion and rising sea levels, those are different, but the outcome is the same. And we basically look at those houses, their values over time as the land erode. And this erosion of land is actually something that is very predictable. There's maps that are showing you, if you live in this area, you're 180 feet from the water, and this land is eroding at 5 feet a year. So it doesn't take a genius to figure out, okay, so 180, how many years basically going to be in the water. And we're looking at all those houses that are first line to the ocean and how fast their land is eroding, what happened to prices. And basically what we see is that homeowners, they just don't care. And that is showing by how much people are paying and for the homes or whether they are selling or not. So basically, it plays almost no effect until the water is right there.
What do you look at right now, and what do you consider to be hotspot areas to focus on?
Okay, so first of all, when I'm talking about real estate investment trust, even though it is in the part of the stock market, I'm not talking about the trading of today, tomorrow, the hyper speed of the market. I'm talking about purchasing, if it is a good investment, whatever trust it is, and holding it for a medium period of time. So looking at 5 to 10 years, and then you reevaluate. It doesn't mean that you're going to just sell it then, but at that point you evaluate. So you need to have this long-term view, just like you would on a real estate investment, right? It's very rare that you're going to be buying a piece of property today and then putting it on the market in 2 months just because the market
You're not a day trader.
changed. So first of all, we need to look at a longer trade. Real estate investment trusts are very attractive for people that want to buy something at market value and getting fair returns. And again, talking about passive investment, and you're talking about diversification, and talking about ease in terms of just ability to move money in and out. Historically, real estate investment trusts return about 10% per year. Right now, if you look at the prices of a lot of those trusts, they're trending for cap rates that are very fair compared to what you can get in the market if you were to buy the property, directly from somebody else. So if you buy a shopping center, industrial park, or a multifamily, directly in the market, or whether you buy it with as an investment trust, you're going to pay very similar prices. A lot of people do not know how to see that it's the same prices, because I know when I buy an apartment, multifamily, and a cap rate is 5.2, if If you understand just a little bit of real estate, you say, okay, I'm getting it at 5.2. When you buy a trust that is selling for $112 a share, well, what does it mean for cap rates? You need to know a little bit more in order to convert it. But what I'm telling you is that right now they would sell for similar cap rates, with the benefit of diversification and passive and all those kind of things. And then, so which one should you do? Well, for direct investment, there's a lot of better benefits from a tax perspective, and it depends on your individual tax situation. And people that do have this tax advantage for maybe should go and buy directly, or for people that really getting a deal. So just to buy something for market price directly, and then you lose diversification, you're putting all your money in 1 or 2 or 3 deals, I think it's a loser's game. A lot of people make a lot of money that way, but also lose a lot of money. There's a lot of things can happen that can hurt your one single asset that may make it a bad investment. So if you tell me that you buy something that should be at a cap rate of 5%, but you got it at a cap rate of 5.5%, great. Or if you're talking about specific deals where you can really add value. So again, you think about there is investment trust. Those are kind of plain vanilla. You're not going to play a specific asset in a specific location, a specific growth story or unique story and make a lot of money on that. You're going to be basically buying the market and do
buying the
well
index
over time. Yes, basically. You can do better if you really understand the local market, the local story of that particular asset or that particular city or that particular, factory that's moving here or company that will move your asset more. If you're just buying something, hey, I'm just going to buy something on market, you might as well just buy your REIT. But if you are led by an advisor that can lead you to those specific situations where you can make abnormal returns, that is where the money is.
I'm going to play a little quick fire question game. There's no right or wrong answers to this. Okay. It's just a bit of fun. So I'm going to give you 2 options, and I want to say one or the other. So, homes or condos?
Homes.
Miami Beach or Coral Gables?
Coral Gables.
Miami-Dade or Broward?
It's a tough one.
Boutique or high-rise?
Boutique.
Office or warehouse?
Warehouse.
Stock market or real estate market?
I think I answered that before.
That's an easy one. Inter Miami or Miami Heat?
Miami Heat.
It's good because I represent a couple of Miami Heat players, so that'll make them smile. Cap rate or appreciation?
Cap rate.
And finally, macro or micro?
Micro.
If you want to know what that means, give me a call.